All right, today we're pulling back the curtain on how a seemingly straightforward industry, insurance, quietly became one of the most powerful money-making machines in the entire world.
So let me ask you something. Does it feel like your insurance premiums are climbing way faster than inflation? Yeah, you are not imagining it. But while your wallet is taking a serious hit, the industry itself is actually celebrating a golden age.
And when I say golden age, I mean it. In 2024 alone, U.S. property and casualty insurers raked in a staggering $169 billion in net income. That's a 90% jump from the previous year.
So how does a supposedly boring industry, one that's built on safety and risk, generate tech company levels of profit? Well, the answer lies in two powerful financial engines that turn your monthly payments into billions for their shareholders.
Welcome to Finance Deep Dive. You know, most people think insurance companies just make money by, well, betting that you won't crash your car. And yeah, that's part of it. But honestly, it's the smaller piece of the puzzle. In this video, we're going to deconstruct their entire business model. We're going to look at the underwriting profit they make from your premiums, and then we'll dive into the massive, often misunderstood wealth generator they call the float. By the end, you're going to understand exactly why this industry is sitting on a mind-boggling $1.2 trillion surplus.
All right, let's kick things off with the first engine, the one most of us are familiar with, underwriting profit. This is the part of the business we all think we understand.
So the basic math is pretty straightforward, right? Insurers collect all those premiums from millions and millions of us. From that giant pool of money, they pay out claims when things go wrong and cover all their own costs. You know, salaries, buildings, commercials, the whole shebang. Whatever's left over, that's their underwriting profit.
Now, for a long time, this margin was actually razor thin. I mean, in bad years with, say, high inflation or a bunch of major hurricanes, insurers would often lose money on underwriting. But just look at what happened recently. In 2022, net income was at $44 billion. 2 years later, by 2024, that number just explodes to a massive $169 billion. The growth is just off the charts.
So how on earth did they do that? Well, it was a pretty simple 1-2 punch: discipline and rate hikes. See, when inflation spikes the cost of everything, car repairs, home construction, you name it, insurers didn't just absorb that loss. Oh no, they aggressively raised your premiums and tightened their standards for who they'd even cover. They basically turned what could have been underwriting losses into massive gains by passing the bill directly to us, the consumers.
But here's the thing. That underwriting profit, that's just the beginning. It's what fuels the second, and honestly, the much more powerful engine of this entire money-making machine.
It's like this. If underwriting profit is the bread and butter of the insurance business, then what's known as the float, well, that's the secret sauce. This is a concept that was made famous by none other than Warren Buffett. And here's the reality of it. You pay your premium today, right? But the insurance company, they might not have to pay out a claim on your behalf for months, years, maybe even decades. So in the meantime, they don't just stick your money in a vault somewhere, they hold it. And, more importantly, they invest it. And that massive pool of your money that they're investing for their own profit, that's what's called the float.
The process itself is almost deceptively simple, but it is incredibly powerful. You pay your premium up front, the insurer then holds and invests that money for months, years, or even decades before they might ever have to pay out a claim. It's kind of a genius setup when you think about it. And because insurers are holding trillions of dollars in this float, even a tiny return on their investments generates billions in what is essentially free cash. And the economic environment lately? It's been absolutely perfect for this strategy. With high interest rates, insurers could just park all that cash in super safe government bonds and earn a fantastic yield with practically zero risk. And the result? Property and casualty insurers have been pulling in a steady $70 billion a year in net investment income. So here's the crucial point, right? When you combine those aggressive rate hikes we talked about with all this high investment income from the float, what you get is a fortress of a balance sheet. The industry's policyholder surplus, which is basically the giant safety cushion they hold, has now reached an all-time high of $1.2 trillion. That isn't just a cushion, that's a financial fortress. And what this does is create a powerful cycle of dominance. Think about it. Even when catastrophe claims spike because of extreme weather, these companies are so well capitalized now that they can easily weather the storm. And what do they do next? They raise rates on everyone again and just keep compounding their investment returns, making that massive surplus even bigger. It's a cycle that just feeds itself. So when you boil it all down, How do insurance companies really make their billions? It's actually pretty simple. They operate a casino where the house always gets to set the prices. And while the game is running, they take all the chips and they go invest them on Wall Street.
When you're looking at $169 billion in income and a surplus of over $1 trillion, it becomes crystal clear there is no business quite like the business of risk. So maybe the next time you pay that premium, it's worth asking yourself, are you just buying protection? Or are you also funding one of the most profitable games on the planet?
If you found this breakdown helpful, hit that like button. It really helps the channel. And make sure to subscribe to Finance Deep Dive for more unfiltered looks into how the money world actually works. Thanks for watching, and I'll see you in the next one.